and Nixon. I think Hayford has his hand up. Maybe he wants to make a comment before we begin.
Not necessarily. I had asked them to raise their hands if they can hear me.
Sure.
Unless Hayford has something to. Yeah.
Okay, sure. All right, understood. Thank you. I hope you can see my screen. And you can hear me well. If it's a small group, they say that the fewer the merrier, I guess. So it's essentially, I'll keep this brief and it's just so that we have some time to also chat freely on the topic that we are going to talk about. It's essentially, we are talking about fixed income securities. I think the last webinar we did was to talk about investing on the Ghana Stock Exchange. So today we are not talking about equities, we are talking about fixed income and what your options really, are or may be. Okay, so really, there is a big need out there. How do we even arrive at the fixed income space in the first place? Fixed income, as the name suggests, it's an asset that really you have invested in or you own, and it can pay you some level of, or can guarantee you some level of cash flows periodically. And so that's in its broader sense is what we can term as fixed income. So really, why does these things happen? The big need is that governments and corporations need financing. Financing to do, or governments need financing to run the country, to run the economy. I mean, obviously, taxes in our part of the world and tolls and levies and grants are not enough to run the economy. And so there's the need for extra financing. And then you ask yourself, where is that going to come from? Corporations also go through the same need. There's always not enough money or funding to do things. And so once you need the money, you need to find a place where to go and how to even take that money. And so it's either you are taking it through equity, which is shares ownership, which we talked about the last time. But what we are focusing on today really is the debt. As you borrow, if you need the financing, you can, a very straight one is to borrow. And so if you're borrowing, you are going to be dealing with investors. Somebody has to lend you the money and you have to borrow in order to use that to do what you want. Where do you go to borrow this money? Once you're borrowing, it becomes debt to you. You hold the debt, and to the investor, you are actually lending, or you're holding some instrument that points to the fact that you have extended money of financing to the government or a corporate, and therefore it is debt to the government or the corporate. And to you, it is your investment security that pays you a fixed periodic sum of cash from time to time. Typically, you would find that where do these corporations or the government go to borrow or to issue debt instruments? So they come to the Ghana fixed income market because it has to go through an organized, regulated market, not with the regular market that we see. And so the Ghana fixed income market is set up such that, you know, fixed income securities can then now be issued there, can freely trade among investors, and governments and corporations can tap into that market to raise the necessary financing that they want. So we come to really fixed income, the security itself. The key characteristics that you would find, they are debt instruments. Is a debt that has nothing to do with equity or ownership. It's a debt instrument. It will either be issued by a corporate or a government for various reasons. It will typically have, you know, a tenor. Maybe it's for a 1 year, 2 year, 3 year, 10 year, 20 year, which is the maturity. So I'm issuing the debt, or I'm taking money from the investor today, and in 10 years' time, I want to pay back plus any other, you know, interest rates that we have agreed, or coupon rates, which is equal to the interest rate that the bond is bearing at the time of issuance, or the security is bearing at the time of issuance. There are things that you would also find, which is the price. You know, what is the price of that debt, or at what price will it cost the government or the corporate to take money from investors? How much should they pay for taking money from investors? And investors on the other side will say, how much should I really expect to earn for giving my money out in the form of a debt or a loan to the corporate or the government? We've already talked about it, paying fixed amounts periodically. And typically you would find that there's a rating agency that is looking at the institution or the government that is issuing these securities in exchange for money. They are essentially checking ultimately that they are credit worthy. Investors can trust the system, the corporates, and can lend money to these corporates or governments. And so rating agencies are quite important, very big in the industry when it comes to issuances of debt and these fixed income securities. The other key thing really is the tenor, the maturity of the fixed income security you want to look at. Really, that presents us with two markets. One is the money market, which is really the short market or the cash market that is less than 1 year. So all of the instruments, that's all the borrowings from the corporates or governments that fall within a year. Say, you know, give me money for 6 months, I'll pay you back. Give me money for a year, I'll pay you back. The banks will come and say, you know, do a fixed deposit with me, I'll pay you back, you know, after 6 months. These are the types of instruments that come under the money market space. And typically, because they are almost cash or near cash, they tend to be safe. They are less risky, especially when it's being issued by governments or quasi government institutions. So you typically find your treasury bills. Cocoa Board from time to time issues bills, raises money from the fixed income market in order to finance its operations. And so from time to time, you would find that happening in the market. In terms of mutual funds, I mean, there are money market mutual funds that sort of pools every investors 100 CD, 200 CD, 10,000 and upwards into a pool and sort of appoint a fund manager to look, at how to invest the funds in these short-dated instruments, treasury bills, cocoa bills, fixed deposits, and other commercial papers. The other probably bigger market, which is a fixed income capital market, where you see a longer maturity, a longer tenor securities that are issued for more than a year, 2 years, 3 years. That's where you find the government of Ghana has issued up to probably 20-year bonds that are trading in the market. You can hold that bond till 20 years, and at the end of the 20 years, you will get paid back all things biblical by the government. In this space, you will also find corporate bonds. They are non-bank financial institutions who, from time to time, at the time, because of high interest or borrowing costs from the banks, tend to come to the fixed income market, where they will tap into investors' capital and raise financing at a cheaper price in order to run their preparations. So the investors typically would ask for more return, for more interest, on these bonds by corporates, because again, they always want to compare it to risk-free instruments, which are usually issued by the government, right? And so if the government, let's say on a 3-year bond, is paying you 18% every 6 months periodically, why would you then want to, buy a corporate bond with some level of risk at a lower return, say as 17%, or even at the same 18%? So that's investors need to be adequately compensated for taking further risk away from what the government of Ghana is willing to pay. In that same space, you would find Euro bonds that corporates issue. Governments have really tapped into the Euro bond market space. I mean, bonds that are issued outside of the country's jurisdiction and in US dollars. And so it's been a good source of raising capital for the government of Ghana, over the years. And investors have found it quite decent to also invest in Euro bonds, as it gives them, a stable cash flow, and also protects them against the currency risk, because again, they are going to be earning coupons or interest payments in US dollars. So these are the key things, long, short, when it comes to you looking at maturities. Then how do we quickly really access the options I have been mentioning? Either it's less than a year, treasury instruments, which are short-term, or the long-dated ones, which are bonds or fixed income funds, mutual funds. So there's a primary market where corporates or governments will come and make a fresh issuance and say that, look, 2 years ago, I was in the market, I came to you, investors, I said, give me 10 million or 20 million. You gave me, we agreed a price and a return. And so far, I have been paying you, your periodic returns. Now, 1 year down into the line, this corporate or government institution can come back into the market and say, look, I need more money because I have X, Y, Z operations I need to do. I need to raise more money. And then, so they would use the primary as the first issuance. They will then come and tap into the market and issue these bonds. The ideal part, most investors like to buy at the primary auction because, again, it's not subject to secondary market trading fluctuation sentiments from other investors and brokers. Because what the government is offering, you are able to quote what you want, and by consensus, once a price is established, that is what you'll take. And assuming you hold that investment until the time it's due for repayment, you will continue to be receive those cash flows. And the way to access them is through the primary dealers. Currently, some selected banks are primary dealers, and some brokers are primary dealers as well. I mean, IC Securities is one where I work. We are primary dealers. At the same time, we are bond markets specialists as well. What the bond markets specialists do really is to advise the government of Ghana as to how the things you should take into consideration when to come to market, the pricing of the bonds that they want to issue at any particular point in time, and at the same time help them to raise the capital or the funding that they need to run the economy. The other access point, the second access point, is the secondary market. Secondary market comes after the primary market. After the fresh issuance is done, there may be investors that based on their timing of their cash flow, were not able to participate in the primary issuance. And so they come to brokers and banks and say that, look, I have seen this bond that has been issued a week ago. I'm interested and I want to buy that bond as well. Again, subject to how the bond is trading. Or unfortunately, we don't have mutual funds that are on the market exchange traded, mutual funds that are on the market that you're able to track and invest in through the market. You would only have to do that through fund managers who are running those mutual funds. Let me skip to. So yeah, so as we have talked about all this, really, we have a variety of options. I mean, but in buckets, there's a primary market, there's a secondary market, and then there is the core market, which is the money market, and the fixed income market or the capital market, where you are dealing with long-term or longer dated instruments or securities. The idea behind that is that the longer you buy, the longer dated a security is, it means you are willing to put away capital or invest for long, and that you should be compensated by the issuer with a higher return. But there are several factors and considerations that affect that pricing. In theory, that is what is supposed to be, but the market gets distorted from time to time based on the information that comes in. Key considerations are, once you are investing in these instruments, you need to think about your yield. You need to, which is how much really you are extracting from that security or investment that you have. How much is this instrument, T-bill, yielding me? How much is this 10-year bond yielding to me? And that can be translated into a price. such that you know that when you buy a certain item or an instrument at price X, come 2 days time tomorrow, that price should go up such that you can earn, you can make some capital gains on that. There are terminologies around face value and principal, and this is really key. Face value is really, if you are buying a bond or an instrument, is really what you are going to be earning the interest or the coupons on. And so in bond trading or in fixed income markets, in its simplest form, if you give out money, more money for a lesser face value, you are shortchanging yourself. I don't know if I hope you do understand that. If you need to buy an asset which the face value of that asset, the price of that asset is 100 cedis, but you are paying 120 cedis so that you can have access to that 100 cedis. You are buying that security at a premium, and so you need to check that. If vice versa, the opposite is also true. I mean, if the asset is on the face of it is 100 cedis, but you are paying 90 cedis so that you can be earning on the 100 cedis, then that's a good purchase and it's at a discount. And there are several factors that make these instruments either trade at a premium or at a discount. One of such is interest rates, inflation rate movement, even accrued interest. I mean, because once you're a holder of that security, you need to be mindful of the fact that every day that you hold that security, interest is accruing, even though it is not paid on a daily basis. Your interest is accruing to you. And so at any point in time that you need to sell that security in the market, you need to then again price and be mindful of the interest that has already accrued to you by you holding it, and then add any other factors in the premium to that security. The other key things really, and this is especially when you are investing with corporates, is the credit worthiness. Is this corporate that is borrowing from you through a debt instrument, through a fixed deposit, through a corporate bill or a bond, are their operations such that they can pay you back when they say they need to pay you back? I mean, there's several instances that has happened in the market, in the banking space, even in the corporate bond space, that issuers have defaulted and have not been able to honor these debt obligations to investors. And that ties into the default risk, because you are not necessarily going to chase higher yields because it's a corporate paper. Issuers, those corporates will entice you with a premium. But then again, you need to look well. You need to look at the rating reports on that corporate issuer to determine really whether there's a high level of default risk or not. And that brings me to the final part, really. What are your objectives for investing across the fixed income space? Are you looking at short term, medium term, or the long term? Again, it comes back to investment objectives. If you are really looking to do a project in 6 months' time, it will be difficult for anyone to advise you to go and buy a 2-year or a 5-year paper that has just been issued at a higher, coupon or higher interest rate. You could, but it's a bit more unusual that you would mismatch your objectives to a rather longer a 10 or a longer dated instrument. Because it can trade on the secondary market, you can still buy the 5-year paper and sell it in 6 months' time. But again, you must know the market well such that you will be in the money, or you make some money once you sell that. You'd rather want to be on the safer side into treasury bills, even though returns are not compared to the long dated papers. But again, because of your objective, you'd want to be in near cash, and you can easily convert bills or fixed deposits by banks into near cash and do whatever you need to do. However, for long-term investing, you need to look at these long-term bonds that are issued by governments and corporates with a higher yield. Yields are around 19 to 20% for 5-year, 30-year papers, and so it's good to check your timing, your return, and overall your objective. There are a number of places that you can check. Really, the ultimate source of this is the Central Securities Depository, which I have pointed out, which is the CSD.com.gh. A list of all the instruments are there. Dobia seems to compile it in a way that is easy to understand and extract the yield and the return, how many have traded, what investors may be even looking to do around how they trade those papers. And you can actually see the price, whether it's trading at a premium or at a discount, and then you review your objectives around that, and then you really speak to your broker or a bank to make those purchases in those instruments. And again, I mean, Dobia compares a lot more of these fixed income and money market funds on its site, and you can see the year-to-date return that those funds are doing in the market. I hope it's been useful. I will pause here. If there are any questions, I will take them, and then we can carry on.
All right. Thank you. Thank you very much for the insightful presentation, Randy. At this stage, we will invite the participants. If you have any questions, you have an opportunity to interact directly with Randy.
Right. So I see there's a question from Hayford. Says, I have a CSE account with IC Securities investing in equities. If I want to invest in fixed income with IC Securities, do I need a CSE account, or how do I get one? Yeah. So good. It's the same account. It's a Central Securities Depository. So that holds all your financial securities that are traded on the fixed income market and then the Ghana Stock Exchange. So yes, you can use that same CSE ID to buy fixed income securities. Yeah. I hope you're okay, Hayford. Sure, okay. Thank you.
Thank you very much, Randy. To the participants, if you have any question, kindly ask or type it in the chat or question Q&A box.
Yeah. So I have seen a question from Nixon. Why is the coupon rate not disclosed until the day of auction. Well, it's usually it is disclosed. So there's a pricing guidance window. So the transaction, the auction is announced ahead, maybe a few days, 3-4 days ahead of the day of the auction itself. And then 2 days and a day between 2 days to a day to the auction, a pricing guidance is also released. And what that does is to tell investors, is to give investors a range, an interest, a coupon rate or an interest rate, a yield range that the issuer is looking to, the issuer is looking to not go under or go, or go above. So it's just to guide the market where the optimal range is. So it's usually done. Maybe you need your broker or your bank to keep you on the mailing list because it's always sent out. You can reach out to me, and then we can put you on the distribution list admin as well. But that's always there.
Okay, thank you, Randy.
All right, next thing, sure. Any other question? What is the expectation of interest rate movement in the medium term, Evans appear? In actual fact, I mean, we can, if we take a cue from the central bank, the MPC, the most recent MPC direction is that they want to keep interest rates low, and that's why it was stepped down from 14.5 to I think 13 rather than half. So there's a clear direction there. There's also a clear direction from the government that interest rates must still, go down. One, to increase credit and lending in the private sector. So there's a drive for government securities to trend downwards. And even by way of external factors, it's already rates are trending downwards on the fixed income side of things. Yields are coming down. Again, exchange rate fluctuation is seen to be reoccurring. All the gains that the city made half year is being eroded. There was a Fitch rating. Again, I think I talked earlier on about ratings. There's a Fitch rating on Ghana that gives a negative outlook, and our bonds are also heavily traded and owned by these foreign institutions, and there's quite a bit of sell-off in the market. So yes, in short, interest rate movement expectation is a downward trend. Hopefully the big sell-offs will reduce so that there are not spikes in the rates. Yeah.
All right, thank you, Randy.
Yeah, hello, any more?
Thank you very much, Randy. Just to give a last minute opportunity to the participants, if you have a last minute question, this is your final opportunity to ask or interact with Randy directly before we bring the webinar to a close.
It seems everyone is fine. I see yeah.
Yes. All right. Thank you very much, Randy, for enlightening us.
All right. Thank you all. Hopefully we will catch up soon.